Welcome everyone to the Kendall Report. Sorry I'm a little late tonight. Had some complications, but here I am. It is Thursday night, and this is the final video for the week. And what a day we had, right? Everybody was expecting if we got a hot PPI, what would happen? We would get a big sell-off, right? Wrong. Bears had to cover up. Markets just kind of rebounded off of the reaction. I keep talking about that trade that I showed you many times on live streams during market hours that I've done, especially around news, is that spike trade and to fade the initial reaction. Another big day. We were up a touch over 1% at one stage on the S&P and as well as on the NASDAQ. So markets keep cranking, folks. I told you there's a bias to the upside. We got new Fibonacci targets, all kinds of stuff. Algos are still pointing up. Trends are up. Angle of attack is up. Everything's up. And it's just pretty amazing the scenario that we're seeing here, I think, from the standpoint of what the expectations in the markets and the reactions are. And last night's video, I titled it that I thought, that it would confirm that we're going to get higher rates, and I think it did. I mean, let's just talk about that number for a minute. PPI came in at plus 0.7 year over year, 1.6. That's an incredible number, to 2.2 on the core, and you would have thought that they would have whacked this market pretty good, and of course, all the buyers came in. It's almost, I keep telling you folks that it's the easiest job in the world is if you go watch some mainstream media for about 15 minutes, you know exactly what to do. You just fade them, and you end up being successful. Been the case for many, many years. I tell you, I have Bloomberg over on a 55-inch monitor in my little cockpit here that I reside in, and I think I had the sound on for 5 minutes today. There was literally nothing to any reason to watch what they were saying. I can't imagine what kind of wise words that Jim Cramer had this morning. That must have been interesting on CNBC. Let's go through some of the economic numbers. I'll circle back. We'll set up Friday. We'll talk about coming into next week a little bit, because that's really what what everything's going to be about as we start to walk toward this weekend. It's hard to believe here we are, Thursday night, Friday, coming into the end of the week, and I would just tell you, watch for Twitter if I do get an opportunity tomorrow. I'm not sure. I've been trying to get live on Fridays because I have a little bit of open time. I'm not sure if it's going to work, but just watch the Twitter. Follow me at Portfolio Expert, no E in the expert. So let's talk about the economics. We talked about PPI. Retail sales came in at plus 6. That's better. We had claims come in at 220. That was better. Continuing claims upticked a little bit, but not materially. Nothing there at all. And I'll just go ahead and just talk a little bit about Friday's reports that are coming out. We've got industrial production expected to be up 0.2. And I've been telling you, for the most part, anything to do with manufacturing or industrial production has been negative. If that starts to turn, then maybe we even get more of a bullish sentiment. But it's pretty interesting. If we can hang on to these gains that we have today, I'll show you. This sets up a pretty good tone. I'll go through the database one day removed, as always, during the week. But on Sunday, I'll catch you up on that. But I've got some interesting thoughts on the intermediate database here in just a minute. Also, the other thing that happened, the ECB raised 3 of their key rates by 0.25%. That set the tone. The Fed, I'm telling you, these guys, they were on the phone talking about this, and we definitely have a coordinated effort going on. So I'm sure we're going to see a 0.25, as I've been telling you. I think everything's baked in the market. Even if they did something or they didn't do anything, everything's kind of baked in. The other thing, which was interesting, and the news lines and the ECB, they're calling it a dovish hike. Oh man, I'll tell you, the world we live in, folks, it's just pretty hilarious because they're trying to set the tone. We're raising rates, but it really doesn't matter. And I don't think it really does to a large extent on what's going on in the economies. Europe's got different issues. This channel is not about Europe unless it's really materially affecting what's going on here in our domestic markets in the U.S. But, oh my gosh, the messaging and the mix of how they try to position everything, it's like it's trying to say Brandon's not corrupt. That's what they're going to do next, right? And so it's a scary world that we live in from I guess from the news cycle viewpoint. Is you can't believe anything you see out there. It's crazy. The books are cooked, as they say. There's a great if you haven't seen that George Carlin skit that he did on the whole government and how they've got a client and you're not part of it. I'm kind of paraphrasing a little bit, but the bottom line is these numbers are good, folks. There's no arguing about it, and I'm not going to use. I hope you never. I'm only going to mention this in a sarcastic tone, but you should not ever hear me go, the Fed's going to be higher for longer. That there's all these little cliches that all the analysts, if you go and watch any of these shows, those little cliches, there's others that just go around Wall Street, and it is embarrassing to say the least. There doesn't seem to be anybody with very few people, I should say, with a unique view on what's going on. It's certainly anyone that shows up on the CNBCs or the Bloombergs of the world. And obviously all those people are handpicked to be on there, and no one really wants to rock the boat. And, so interesting situation. So let's talk a little bit about the Fed, and then we'll do another quick review of the market action today. But the Fed has got all the information it needs to go ahead and raise rates next week. I've been steady on this all along. Could be wrong, but I think we'll see an increase of 0.25 next week. Not sure it matters of any sort, but it is out there. So just know that this is how it's going to look coming in, and folks are going to be scoring up positions around. Now, the title of this video I put out tonight is there going to be an auto strike? And if there is, does it actually matter? And my answer, I think somebody already stole my punchline early on, is the answer is no, it doesn't. And even though that would jack up the employment numbers and do all kinds of stuff, I don't think it will. But if you look at the demands that the unions are making, it's going to be pretty hard to come up with a deal. So it'll be interesting to see what comes out of this. They're playing chicken. Who's going to turn the wheel in the last second? Maybe nobody. Maybe it's a crash and burn. But regardless, I don't think the unions are going to get anything near the story. I've got a great union story. I won't tell it tonight. I've told it many times on this channel. But I think that the workers, once again, are being misled by their union leaders, and that's a shame. Okay, so let's talk a little bit more about what went on today. S&P up 0.84. It's up 17.3 on the year. We got the NASDAQ up 0.81. It's up 33.1%, and the Russell was up 1.4. So it's up 6%. And this configuration that we're seeing here has been the way it's been all year long. I mean, we've seen the Russell lag, NASDAQ lead, no matter what interest rates do, no matter what the so-called large tech stocks that are supposed to do terrible and higher interest rates have done wonderfully. And even Apple is trying to bounce out of its little slump that it's been in as well. Also, sector-wise, energy was one of the stronger sectors today. Real estate, now we got probably a confirmation, and we got real estate that interest rates are going to go up. So real estate rallies 1.7%. All 11 sectors were up. So there was nowhere to point to a negative today in what should have been, by most folks' viewpoint, should have been a negative day just based on the action in the PPI. But like I said, all these other metrics are coming in really, really good. Everything from the employment, the retail sales, it just goes on and on. And I talked a little bit about the retail sales number, is it doesn't really matter how the retailers are making more money. They are, whether it's through margins or total sales, whatever. It is expanding, and there's puts more money out there in circulation, no matter way they get around it. Products are moving. Folks are buying stuff, not going away. So anyway, so let's go ahead and let's get into the Wavetech database. I'll set up what I think is going to happen as we come into the next week, as well as we go through the database and we come into the technicals. So let's go ahead and get into that. So here we are at the Wavetech database at 29.61. The number that I've been telling you about here for a little bit is 28 to 22%. And the whole patterns that we've been seeing is this volatility in the short-term database. I think we stabilized probably after a day like today. We'll probably pop up back to 32, 34. Those of you that have the Wavetech platform, you have this platform, you'll know about that here in just a couple hours. So it looks to me like we'll just see a bounce back into a 30 handle somewhere. So let's talk a little bit about the intermediate. And I'll just say, Floyd's Garage, I'll just say to you, the worse it looks, the better the markets do. So it looks like bad news is good news for whatever reason. Interesting kind of segment. But let's go over here and look at the weekly numbers here. I'll just go full screen. We're at 60.98 on the intermediate database. So 61% of the stocks. So let's just call it 61 out of 100 stocks are long. And these are stocks, mutual funds, ETFs, probably 0 bonds long, not very many bonds. I looked for bonds, and it's just one of those situations where what we're seeing in the database here is it's pretty sticky. This trend that we've talked about for a while now. This goes back a year ago. I mean, we're almost into October. It was about a month from now is when we started to see some serious traction coming in September, late September, early October, and it just grew from there. We just continue to get more and more traction in the database. We got up to like 78% on the intermediate, and that's what happened. And what's happening here from the database standpoint, and I guess I'll put you folks through a little bit of redundancy, and I'll show you. Let me just bring up something here 1 second so I can get that over there to you. I think you've seen this chart a million times, but it's appropriate time to actually bring it up here. Just let me, bear with me just 1 second while I bring this. It's this classic chart here, which is showing you how the database responds during the trend. And we hit up a little bit more than the 72% on this run. And what that, so now we're starting to see it decline. We're back from 76, 78% back into 62. I think we pick up just a little bit here. I think if we hang on to these gains, and we're close pushing 40, 45, 50 plus on tomorrow's close. We'll go through the technical stuff here in a second. But from that standpoint, if we stick there, we should see possibly some positive rotation, maybe start to push back toward 64% bullish, maybe even 68, and that will set a more positive rotation. And that's what happens, even though we get these little blips. If I blow this chart up a little bit, I think I can do that. Yeah, I just blow it up. You can see it's not the percent is jagged coming down. It expands and goes up and down. It's lower lows and higher highs on mostly, even on the database, as it's starting to go through it. It's attrition, but for the most part, what we see here is a declining percent bullish, but there's a rotation in stocks. I've tried to explain this many times. What happens is the stocks that led us off of last October are about a year, been long for about a year. So I've shown you other parts of the database that the intermediate database tends to hold for about 220 days, roughly 240. Those are market days. So that's about 1 year, a touch more in some cases. So what we're seeing is that first batch that came in last year, or most of them, are starting to roll out a little bit. And we're seeing the new buys that we're seeing are new rotation, which will keep the percent bullish long for a little bit further. And when we look at, let me just back out of here for a second. When we look at some of the stats, when I go to the all stats page in Wavetech, what you'll see here, and from a statistical viewpoint, is we're looking at right now the average current duration is only 68 days and the average holding for the entire period is 204. So right now we are at 33% yielded of the expected gains. The one thing that we're seeing here when we look at, that's the duration, that we're looking at, and the percent gains, our average profit is about 30% on these trades that come out. And then what we're seeing here right now is only at the moment, profit fulfilled is only about 13%. So this view of the database would actually suggest that there's quite a bit more ahead, and we could end up playing this thing out through the fourth quarter and maybe into first quarter if it starts to extend. I won't go through all the stats on this page, but some of the other elements that are on this page, we've got, of all the sectors right now, we have 9 of the 12 sectors are long. Everything is everything is not long in the tooth. There's a couple. Capital goods is long, a little bit long, but everything else is in pretty good shape. Still looking forward for the expectation of the overall trend to continue to unfold here. So just know that is the case from the standpoint of looking at strictly at the database. And this is a very good guidance tool for those of you that have been around the channel for a while. You'll know that's the case. Let's go ahead and get into the technicals. All right, starting with the S&P, we're definitely looking at, this is the hourly chart. We've got a bit of a dragon head unfolding. I should, on my other machine, we got it. I'm going to look at a value, so just bear with me 1 second, because those of you that have the indicators, you should be aware of this value here, so bear with me. I'm just trying to find it, of course, just because I said it. Bear with me. The market flow actually issued a buy signal right at the lows today, and I'm trying to get the right settings. Sorry, I'm not going to find it very easily. I meant to have that for you, but we definitely had a perfect right here on that reversal. We had a buy signal. We got a positive bias. Now what we're looking at, this is somewhat interesting. Looks like into the London Open tonight, we're going to come back into these moving averages. I think we hold above the simple 10 on the hourly. That's 45.51. I'm going to give you some numbers here. It's going up about 3 handles per hour. So by the time we get to London, that thing is going to be around 57. So we probably go sideways, and it looks to me that as we come through the overnight session, we'll probably ultimately trade down toward the 21-hour moving average. And where we'll see this a little bit better is on the daily chart. So let's go ahead and take a look at that, and we'll look at the market grid from that level, and we'll start to see a little bit of what's going on from that standpoint. And you can see it's very interesting is that PPM1 is still, it's at right now 0.09, so it's not in any bullish mode. I talked about this last night, but we were able to trade all the way up to STX 45.55, 45.51. So we got an RTX. I said STX, I meant RTX. So we did get an RTX sell signal, suggesting we get a day or so, maybe 1 to 2 days sideways in this pattern. And like I said, the new Fibonacci targets that were just put out 3 days ago is suggesting a minimum move to 46.16, which is a retest of those highs back in August and July. And then the next level is huge because we're looking at 46.86, 47.29. All of a sudden, you're thinking about an ATH all-time new high from that standpoint. So I'm thinking that the way things are configured, it looks like we're just going to ultimately maybe move a bit higher. I still think this 46 handle is going to be pretty formidable, getting above, even with the rollover and the premium and all that. We did see the old contract that we were trading for a while actually print over 4,500 briefly today. And that's it. Actually, then went out at 45.08. So it managed to get back over 4,500. When I was talking about that contract, just to look back on that rollover, as I said, we're going to have a hard time getting over 45.50. But because of the premium and on these forward contracts, we're looking like we're going to at least get up to challenge this level. But I would watch for some rejections. We'll look at the numbers as we come into Friday. I'm not sure too many people are going to get ahead of the Fed meeting next week, but let's take a look at the market grid for tomorrow. Matter of fact, yesterday, I just want to look at the range. Yesterday was 45.19 low, and we had S1 was 09. I thought we could hit S1, R2. I was fantasizing about R3, but we went above RXT and actually got to that level. As we look forward, typically after an RTX sell, what you'll get is you'll trade down to an S1 pattern. You go R1, S1. It usually flattens out a lot. With everything that's coming at us coming into next week, we might see a little more volatility on that. And I did mention yesterday that when we get to the narrow ranges, now we got an expansion in the volatility in the last 2 sessions. So now we're starting to see some higher numbers come into play. So S1, 45.46, that's probably your extreme on the downside. R1, 45.63, R2, 45.73. That's printing some pretty good numbers here ahead of the weekend and all that. So just expect that we stay within the market grid, probably S1, R2 max. And as always, you use these numbers as a pivot. So if R1 is taken out, or S1 is taken out at 46, that put us down to 36. But that's a pretty steep decline, I think, based on what's going on out there. And we don't really have any material numbers coming out tomorrow. I mentioned the reports. We got a capacity utilization I did not mention. That's coming out. But these are, while they're important for sentiment, they're not really likely to trigger any kind of volatility as we come into Friday. So expect to see this thing kind of just normalize out here, at least coming into Sunday night into Monday morning, especially ahead of the Fed and everything we got going next week. I do want to just bring up the weekly chart just briefly, just to bring you into context with what we got going here on the weekly. Next week is actually suggesting that momentum's going to flatten out, but the 10-period moving average 4507, that 4500 level is going to be pretty strong support in there. But one of the things I wanted to point out is from a market grid standpoint, we got up to 62 so far. R2 was 4569. S1 is 4483, and we printed 4495. So we stayed well within S1, R2 so far. I don't think we get above that. R3 on the weekly is 4600. Next, we'll cover the NASDAQ. I'm going to stay with the weekly chart here just as we come into analysis on the NASDAQ. And it looks to me, as far as where the PPMs are right now, PPM 1 is a positive 0.32. Anything over 0.25 is a bullish trend. It's actually in trend mode, which tells you there's only about a 60% probability that it stays above that value. Now, this is a weekly NASDAQ, and that if we look at this week, that was the value coming into this week. And if we look at the lows, 15,406 was the low, 15,394 was that 10-period moving average. So we bounced basically right off of that and have pushed up, and we're in a process right now of pushing through 2 weeks ago high where we hit RXT weekly. And if we just look at the weekly chart here on NASDAQ, the potential is here for a move. Next level, R2, 15,796, 15,955 is probably wishful thinking, but we easily could hit this R2 number. Let's take a look at the daily here. Let me just fix this scaling. So daily, pretty nice move back above, but daily is starting to flatten out. And this is what I was trying to indicate on the S&P is we should, since we got on the S&P, we did not get it on the NASDAQ, that RTX sell signal. We should flatten out for tomorrow. I suspect tomorrow will be reasonably stable, and we should trade S1, R1, maybe an R2. I don't think we expand much on the downside. There's certainly nothing coming out. And the Fed's in quiet mode right now. You're not going to hear anything out of any of the Fed presidents or any noise out of the Fed right now ahead of the week of the meeting. So expect to just see this thing starting to flatten out a little bit. There's still a little upside, and I would definitely call it S1, R1, and look for those numbers to be pivot levels. Like R1 is 15,720, trade above that. Then R2 is 15,772, and then on S1's 15,626, and then 15,574 would be the next level if we pivoted below that. But just expect, I think, a fairly stable range. Everybody starting to talk and get set for the news and elements that we are going to deal with this week. And the Fed has so-called all their numbers. I told you they have other meters, but we've got CPI, PPI out, and both of them a little bit hotter than everyone. But I wouldn't say everyone wasn't expecting, because we did have expectations of inflation starting to tick up. And I think these increases are going to be enough to keep the Fed, as far as the rates going, continue to see some increases. And whether we get another one in November or not, we'll let this one settle. We haven't got through this meeting. All right, so we'll start with the Russell cash here. This is daily cash, looking at trading into some of these resistance areas. What's interesting about this is we did get a crossover on PPM2 on first and second derivative. It's kind of a mixed picture. I talked about this 10-period moving average being a pretty substantial resistance, and that's at, this is cash now, 1868, and that value is 1870. That's where it is right now. And yesterday's value. I'm going to put RTY up here. I just want to see, basically we're looking at a stable type situation. And I mentioned this yesterday, we do have some new fib targets to the upside on the Russell, but there is major resistance now on the Russell at the 40-day moving average, which puts us right at, get the right number, 1914. That would be the ceiling on this at the moment. And you see it looks like a couple days, and looks like we're trying to get these PPMs and the algos to turn a little positive. But this, as I mentioned on the opening comments, this is a big laggard from the standpoint of what's going on from that standpoint. All right, so I've got the daily 10-year up here. We continue to see a bouncing around. As I mentioned, we're probably going to stay above these averages. We dropped just below. We get down to 4.23. We had a high of 4.298, basically 3.0. So we're working within that range. If you look at the market grid, that was right within the ranges of the market grid. 4294 was R3, and S1 was right there almost exactly. S2, 4.222. We got to 4.223. So we stayed right within the market grid there. And it does look, as I pointed out yesterday, that we've got, this is sort of a peak value. So if we start to tail off, we could end up coming down in toward this, I'm going to call it 420, 415 level over the next several days, and come back into this little wedge here, because at least in the short term, we come into next Wednesday, we're seeing it that the algos are suggesting we're going to turn up a little bit on Wednesday. It looks like we could be flattening, maybe sideways to down a little bit as we come into that range. Let's take a quick look at the 2 year. 2 years just also bounced back, but staying right above those averages. And this is where we should remain in during this cycle. We should remain in this pattern. Looks like the same thing. We got a little blip down, and then as we come into next Wednesday, we're seeing the potential bottom at least being forecast. We'll see what it looks like when we come in next week. But that is about it from that standpoint. There's really not a lot there other than that. Next, we'll go to crude. I mean, crude's just going to the moon. And I meant to mention this earlier, but the bulk of the producer prices and the increases were coming from energy. And as I mentioned, that energy was one of the strongest sectors today. And all of a sudden, you know, we're up here printing the 90.79 here on West Texas crude. And we're seeing this upward slope I've been talking about. The algos have been spot on, folks. If I turn this chart back, it's been forecasting this slope for close to 10, 14 days in the future, and it looks like we're going to continue to climb. The only thing that's happening here is we're seeing momentum being lost. PPM1 has turned through its first derivative. PPM2 is flattening out. But as I've been talking about over and over like a broken record, somewhere around the 19th and 20th, right at the Fed meeting, is where a lot of these charts are starting to show some sort of a rotation from the standpoint of maybe a switch in some of these trends on some of these commodities. And I will try to put out some sort of scenario as we get into maybe Tuesday night's video. Yeah, so much for buying crude oil back under 30, right? So much for refilling the SPR. I mean, what amateur moves, we talked about it several months ago. All I can say is, wow, we got a bunch of idiots running the country, and it's amazing that somehow economically and that things continue forward. And maybe we're all confused. We don't actually understand how Bidenomics works, right? It's a crazy scenario from the standpoint of what we continue to see, economic output and the like. So let's, so crude oil looks like it's just going to continue to climb up. We got a floor now around 86, 87 on the downside. And right now there's just some potential for it peaking out, but as we come into next week, but there's still some really good stuff. Now, I thought about it. Somebody mentioned the Dow. I think as to close out the week, I'm going to just bring up the Dow. Let's take a quick glance at the Dow and just take a look at what's going on, because I was talking about, last time I covered the Dow, I think last week, we were still looking at upward prices. So let's go and take a quick look at the Dow, and then we'll go to gold and Bitcoin and call it quits. All right, so here we are. U.S. dollar continues to climb this angle of attack here. This thing is forecasting. This daily will change. We're going to go to the weekly here in a minute, but we are seeing a stabilization of the momentum. It's nothing like some big, robust, parabolic type trend, but it's a really steady trend. And we have all three levels kicking in where we're seeing this angle of attack is flat. It's very easy to maintain this type of angle. And I look at all these PPMs, and most importantly, the 200 down at the very bottom, the PPM 200. That thing is forecasting that the 200-day moving average is going to turn up. If that happens, right now it's actually positive at the moment, but if we continue to see a little more increase in that curve, and it's being forecasted that that's what's going to happen, is the Dow is going to go much higher. And I'm going to show you above here is 3 Fibonacci targets here on the US Dow right now. A high target 106.83, 108.32, 109.24. Those are really big numbers. We're going to take a look at the weekly just to see what kind of forecast we have here. There's still, I mean, the positive momentum, folks, rolls all the way into mid-October. So this little angle is likely to continue. Now we're almost on a weekly up to Fib target 3, which is 105.90, and that's will be the level to watch to see if there's any type of rejection around those levels. And obviously, if we start to see the Dow decline, now it is being forecasted. You can see here in these forecasts, I've got 50 bars out in the future on these algos. So they're sort of kind of okay, but the most important thing really is here as far out as going out. This is the weekly. If I go out here out to December, we're still looking at prices on the Dow remaining over 103. So, but this angle is likely to change if we get much above those Fibonacci's, or even more important, I'm going back to the daily. If we were to hit any of these numbers that are being forecasted on the daily, that's going to flip some of that momentum and start to forecast the much higher prices going forward. And that's probably only going to mean one thing, that interest rates are going to continue to climb along those same lines that we talked about. There's some really mixed messages coming, and I'll try to clarify them as we see a little bit more from the standpoint of how this configuration and the puzzle is coming together. So I always try to see if we can put things together, especially the things that are really related from the standpoint of the Dow, crude oil, gold, even interest rates are affected by some of the Dow being, there's kind of a dual relationship that goes on between the Dow and the interest rates. So that's a little more dynamic relationship, but the others are pretty straightforward. And when you start to get everything kind of pointing in the same direction, you kind of know what's going on. And in spite of the strength in the Dow, I mean, can you imagine if you're a emerging markets, how you're getting hammered right now with the petrodolars going up and crude oil going up? I mean, it's a double whammy. There's folks out there that are absolutely getting their head handed to them in this type of scenario, for sure. All right, next for gold, I saw some really funny comments on the channel last night that people are going, I'm a little obsessed that Peter Schiff is taking, I think somebody said Peter Schiff is taking a vacation in my brain. The Peter Schiff thing is an absolute joke, folks, so I hope you get that. Peter and I ran across each other literally about 5 years ago in Dallas, and it didn't go well. I was hoping it would go well, actually, but it didn't. And so you get two opinionated people standing next to each other. It was not good. But so it's really a joke. I have fun with it. So I almost want to call the changes from the gold forecast to the Peter Schiff forecast, but we'll leave it at that. So I needed to say that there was a couple comments on the channel last night that I thought were interesting. By the way, I appreciate all the live stream stuff that you guys do, and once the broadcast is out, I love the comments. So make sure you do comment on this stuff, and it'll be it's fun. I appreciate it. I look at this timeline right now, and there's a lot of you who've been around for a long time. And I don't even know. I mean, we must be doing pretty good. I'm just looking here. I don't think there's one Smurf to be found tonight. Everybody's gone. I'm going to have to get me some new Smurfs. But anyway, this going to gold finally here is the gold is being forecast. This is daily as we come out. I mean, we're looking at some pretty decent downward pressure, and I've been talking about this kind of for a while. And the short-term charts are very, very negative, but the intermediate to longer term are more neutral than negative. And when that happens, typically the short-term will take control over the market movements and start to drive prices lower. And certainly, if what we're looking at here is these higher yields, then we're definitely going to see probably gold stay under pressure. And we won't even say higher. We'll say stable at where they are right now. They don't have to advance even further. We're at 429 level, 430 level on the 10-year. And I think we're 444, 45, maybe on the 30. But this is a negative pattern that's set up here. So let's just go over and flip over to the weekly. And this is what I'm talking about here, is that what we're really seeing is weekly has more of a stable forecast. So we could continue to be sideways. We basically have been in this choppy sideways range. We can go all the way back to May of this year, and we're just seeing this choppy range. But the forecast is very stable when we get to the weekly. I'm going to click on monthly just to get some context here. And monthly still has slightly upward bias with major support down 1870, probably 1840 would be the extreme on the downside. And that's basically what the daily charts are forecasting, what the monthly is looking at. There are some crazy downward Fibonacci targets on the monthly. It gets really crazy because they're looking at Fib target 1, 1624, 1449, and 1340. So there are some numbers out there. I think that's one of these island projections. I think really that 1840 level, 1820 is going to be extreme if we get down that way. All right, so bringing up Bitcoin here. This is the weekly Bitcoin. Just trying to get the scaling right. So Bitcoin, a bunch of news around crypto world with SEC and all this stuff. Bitcoin continues to be the favorite of the favorites. And what we're really looking at here is once again stable. We got back over that 40. I talked about it yesterday. All of a sudden, we're back at 26,598, and we printed the low at 4,920. And I've been talking about 25.5. There were a couple numbers. We look at this is a weekly chart we're looking at. If we look at the S2 level, 24,959, 24,486 was S3, and we get down to 920. So that would tell us that we got basically right to S2 and bounced off of there. Got a nice green bar working here. So there's some potential, but we got major resistance up above this market right at the 10-period moving average, which is 27.8. And so there's going to be a lot of work. It doesn't look like momentum is going to be able to get much above that. We'll take a quick look at the dailies just to get a handle on what that looks like. And you can see we got this, I don't know, we'll call it a volatility day. And now we're moving up toward the 40-period moving average coming down in here, and that's at 27,000. And like I said, we're 26,606. Here's one of those wedges. We've got an upward slope moving average, and we get this downward slope. We typically will get for 2 or 3 days, we'll hammer in here, and then we'll look to the PPMs to see which way it's going to break out. Right now, it's kind of leaning to the upside that maybe we can get all the way back towards the 200, and there are no other Fibonacci targets at the time. Okay, folks, that's going to do it for the week, if you can believe that. It's hard to believe. Tomorrow, like I said, I'm really looking sideways choppy. There's still an upward bias in the equity markets across the board, with the emphasis on the S&P and on NASDAQ. As far, hopefully this sets us up pretty good as we come into Sunday night. I'll set up the week as best I can. I mentioned to you last night that maybe we'll do a live stream like old school days back in 2021. Some of these long, whether it be full blown, but we'll hang out and maybe at least talk about what Powell's doing and all that. Maybe come up right after that for the last hour or so of markets. But I'll let you know on Tuesday night next week. So, folks, this is it. Another week. Have a good day trading tomorrow. Have a good weekend. See you on Sunday night, same time at 6 p.m. Try to be on time. So see you then. Thanks a lot. And before you go, make sure if you haven't upgraded your indicators, do that, because there is a special code for you folks that bought the first round, and it's a pretty deep discount. So don't miss that. And if you haven't bought them, go to kendallreport.com/indicators. And we've got some plans, like I've been telling you, for a online symposium, some things that's setting up for October. I've got some a lot of dynamics in my life behind the scenes, so I'm trying to coordinate this so that I can make sure that I can show up on a timely manner then. So thanks again for watching. Another week behind us. Appreciate it. We'll talk to you on Sunday.